31
Yeah.
years in real estate, so we're pretty close. Yeah.
Yeah, we are. So, yeah, we've seen, I work for Wintrust Mortgage in Lake Geneva in Burlington. And the information that I had pushed out to you about second homes is a change that we're seeing coming down the pipe from Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac are the industry government-sponsored enterprises that basically set the requirements for loans that will be sold to them, and they set the criteria. So
Sure.
these loan level pricing adjustments, we've actually had them around since about 2008, after we had the onset of foreclosures in the market, when there was some risk involved. And so what happened is Fannie and Freddie came out of that time frame where foreclosures were high. I think we're all familiar with what happened financially in the financial markets in 2008. And prior to that time, borrowers would get loans and everyone would get the same interest rate. So there were no risk-based factors tied to down payment or credit score or property type.
Sure.
And as a result of all the data that came in from the foreclosures, that's when the GSEs took a step back and said, we need to restructure interest rate pricing to accommodate or account for some of these layers of risk that are involved in mortgage lending. So the loan level pricing adjustments were actually rolled out back in 2008, and they've been around since then, but they've been adjusted. So they've been adjusted up or down, and there are adjustments that are put out there based on consumer aspects or borrower aspects on the loan, and those aspects would be tied to, say, a person's credit score, their down payment, and their occupancy of the property. And then there are also factors that are tied to the property itself. Is it a condominium? Is it a single family residence? Or are there multiple units? So what happens with these loan level pricing adjustments is each loan gets analyzed for the characteristics which would add the loan level adjustments. And then those adjustments can be paid in cash in the form of additional funds due at closing. But more often than not, they are actually absorbed into the interest rate. The consumers have the choice whether they want to pay the fees as part of their closing costs, but that can come to thousands and thousands of dollars, or if they want to have those fees absorbed into the rate and reduce what they have to bring to closing. And I typically, when I'm pricing a loan for a customer, I will take a look at both aspects. So if they paid the costs up front at closing, I give them that number, and then I also look at what the interest rate would be if it were absorbed in. And again, more often than not, it's just much more beneficial for the consumer to roll it up into the rate than it is for them to bring thousands of extra dollars to closing.
Yeah, so that's so interesting. Is that a big part of that? Because folks maybe historically are in a house 5, 7, 10 years, and they're never going to have to pay that full amount if it's built into the rate, obviously, because they might take out a 30-year loan, right?
Correct. And when I do that analysis for them, I show them what the rate is if they have those fees absorbed versus if they pay it themselves. And a good rule of thumb is that if they're not going to get, if they're not going to recover the money spent on the fees within 36 payments, don't pay the fee. It just doesn't make sense. And most times when we do the math, it's depending upon how many of those different adjustments are added to the rate. Sometimes it can be, a 7-year recovery period, and more. So, if they're going to get their money back, if they're only looking at, say, 0.25%, a very minor adjustment, if they're going to get that money back within a couple of years, probably not a bad investment, but that just doesn't typically tend to be the case.
Yeah, so that's so interesting. So a couple of the variables that you touched on, credit score being one, type of property being another one. And it elevates with a lower credit score.
Correct.
Price is just a percentage basis, so price affects it obviously as well, right?
Correct, because it is a percentage.
Yeah, because it's a percentage. So as people are taking a look at this and they're coming to you, is this a disclosure that's been around for a long time? Because you had said various aspects or various, types of this same fee have been going on since 2008. What was the urgency for in your message if something like this has really kind of been in place and now all of a sudden April 4th, something different is happening that's going to make a bigger impact?
So there has not been a level loan adjustment for second homes.
Yeah.
And now there is, and it's pretty significant. It's very significant. And we've always had a loan level adjustment for investment properties because there is that understood risk. If the economy gets tight again and
Right.
we've got consumers who are having a hard time making bills, they're going to make sure that they're able to pay that mortgage for the roof that's over their head first. So then second homes have, slightly higher risk, as do investment properties. So there is that level of risk there, but the sense of the urgency was, it wasn't just adding, say, 0.25%. It's significant. And when I say 0.25%, I mean as the fee that's assessed. So 1/4%. So say on a $100,000 loan, 1/4% would be $250. The fees that were added for second home purchases are at some points, depending upon the credit score, they can be over 3%.
That's a big number.
That's huge.
That's a big number. And when I looked at what you had sent, I realized that people could really, be in for a bit of a sticker shock for something like that. That while it can be handled a number of different ways, I'm sure it becomes part of your truth in lending that you give to them after making an application and discuss it, possibly, because that's a number that's going to stand out when it comes to getting a loan,
Right.
So,
and I think a lot of consumers, they understand that credit score now plays into their interest rate, but I don't think that they understand all the other factors that come into play when quoting an interest rate. We used to look at one sheet prior to 2008. You would look at one sheet and know what the interest rate was because we didn't have these loan level adjustments. But now that those have come out, there is an actual, basically interview process that I have to do with the borrower. And they don't always know their credit score, but they usually have a pretty good idea what range the credit score is in. And as you mentioned earlier, the more down payment, the less impact those fees have because you're paying less of a fee. Really the only way to avoid loan level adjustments, that's a mouthful, is to put 40% down on a 30-year fixed rate loan, have a 740 or higher credit score, have it be a primary residence. The bread and butter type of loan with a significant down payment, you can avoid those adjustments, those price adjustments.
right.
You can avoid them on a 15-year loan, but again, there aren't, not many consumers are coming in with that strong of a down payment. So they're going to have some sort of impact to their rate, when we're pricing that out.
You just kind of went dark. Did they turn the lights off and go home?
You know what happened? I have two monitors up in my office because, there's all kinds of stuff going back and I can't operate without two monitors, and they just shut down. They went into, so I should have wiggled like my mouse and brought it back up. And that's actually like where I have my rate quotes and stuff. So yeah,
you have to anyway.
But you know what? Maybe dark's not so bad. Is it too dark?
No, it's fine. You're fine.
Okay.
Yeah, you're totally fine. Hey, so let me ask you this. Interest rates have always been guided by credit for the most part. A lot of people don't necessarily know what their credit score is. But they've also been guided by the type of property because, commercial property, investment property and stuff is at higher rates. So if there's all these other variables that come into play, is this something that you plug these parameters after the interview into a system and the system calculates what the loan level price adjustment is going to be?
Yes, computers actually do it now,
Yeah.
just because it is so complex.
Yeah.
And usually if there's a change that's made by Fannie or Freddie, we typically get 60-day lead time, 90-day lead time, not always.
Right, right,
Yeah,
right.
yeah. So everything is built into a computer program so that it recognizes all those different factors that play in. And you can start with a specific interest rate and specific loan level pricing adjusters, but say in our industry, I haven't seen it in a while where an appraisal comes in low, but if an appraisal comes in low and that changes the loan to value associated with the loan,
Yeah.
then now that can change. That may move that loan up into another tier of adjustments.
Oh, that's interesting. Interesting.
Mhm.
Okay. Well, for second home buyers, this is something new and it's a big deal, and you should talk to somebody knowledgeable about it. Obviously, Sheri is knowledgeable. We want to talk just a little bit before we wrap up today. We want to talk about kind of interest rates, the interest rate environment, where you see things heading, or any other structural changes like this that we're talking about that you've either been, made aware of that are on the horizon for the public, for realtors and so forth. Or, just talk about the interest rate environment and what we see. We were talking right before this, before we started recording, and we're seeing interest rates really creeping up towards 4% right now. In your industry, what are you guys seeing? What are you talking about? What seems to be the consensus about where things are headed?
Well, the forecast for the year is that we are going to see some Fed changes to rates, which would then in turn mean that we can anticipate some slightly higher interest rates. The last couple of weeks have been very volatile, very volatile. We've seen some sharp raises in the rates, and typically when that happens, when they go up significantly in a short period of time, they'll usually settle in and then trickle down a bit. And of course, that trickle down takes a much longer period of time than the spike up. But we just haven't seen that start to happen yet. So where consumers were thinking that they were getting rates in the low threes, they're creeping up to 4. Especially with credit scores under 720, we're seeing them break the 4 level in some in some of those tiers where you've got some other loan level adjusters, be it property type. So we're starting to see that, and I think it's going to continue throughout the year. I believe the last time we were up over 4 was probably early 2019. And for a very long period of time, fixed rates have been so low that people would not even consider an adjustable rate mortgage.
Right.
But now we're seeing there's some advantage, especially with these second home pricing adjustments. There's almost a 1% advantage going with an adjustable rate mortgage. Now, if that adjustable rate mortgage is with Fannie and Freddie, those loan level adjusters are still there. So any lender who only sells to Fannie and Freddie and they don't have a bank behind them or other sources of income, or I'm sorry, sources of loans that are outside of Fannie and Freddie's box, they're not going to have those options available to them. But I have priced a couple out this week where we're looking at putting second home buyers into a portfolio product, say a 10-year adjustable rate mortgage, because then they're back down into that low 3%, 3 1/8, 3 1/4, and that rate is fixed for 10 years. And as you and I both know, the average homeowner is still selling every 7 years, I believe.
Right. Yeah.
So a 10-year ARM is a good product.
So what do you think though about them getting into an adjustable in an upward interest rate environment where if it's a 3-year, right, and then it adjusts, is that the typical 3-year kind of? If it adjusts?
So first of all, I personally, I wouldn't ever recommend an adjustable rate mortgage for first-time home buyers or inexperienced home buyers.
Yeah.
Because they don't typically, it's their first experience owning a home. They really don't know what to expect.
Yeah.
But we encounter home buyers who have bought and sold homes 5, 6, 7 times, and in increasing rate environment, I'm not a fan of short-term arms, like
Yeah.
3-year arms. The only
Right.
time somebody should give consideration to that is if, they know it's going to be a very short period of time for specific reasons. If they are transferred around a lot with their employers, or they know that they're going to be relocating and retiring in a short period of time. But a 10-year arm gives you a 10-year period at a fixed rate where
Wow.
you know that rate's not going to change. And like, there are going to be a lot of life changes in 10 years. So most people would be more comfortable with a 10-year adjustable than say a 3 or a 5-year adjustable.
So 10-year adjustable being it's fixed for 10 years?
First 10 years. So yeah, whenever you hear adjustable rate mortgage, the number that's associated with the adjustable rate feature, that's how long that initial interest rate stays in place and fixed.
Yeah.
So, 5-year arm, it's going to stay fixed for 5 years, and then it's going to start changing.
I didn't even think in an environment like this, where certainly prices are appreciating, but interest is going up, that they would put or keep a 10-year product on the table, a 10-year adjustable. I mean, in 5 years, who knows? It could be 6%. That's incredible, and you can get that for 1% less than fixed rate right now.
Right now, just because we saw that significant, rise in the fixed rates.
But 10 years is a long time for some people. That can make sense for some people.
Time, right? And
okay.
Prior to the drop in rates that started happening 2 years ago, and the floor sort of fell out in February 2020. That's when we saw the sharp drop in rates and a lot of refinances. Prior to that, there used to be a fairly significant separation between the fixed rate and the adjustable rate. And that's when you look at the adjustable.
Right.
But when fixed rates got down to 2.5% for a 15-year and 2.75 for a 30, the adjustable rates were at some points priced higher than the fixed rates. Right. And now we're starting to see that somewhat return to normalcy.
Yeah, makes sense. Well, I just looked at the 10-year bond, and it's like you said, been just going up instead of up and a little down.
Hammered.
Looks like we got a little reprieve today of about half a point or something like that. So, yeah, it's an interesting time to be in real estate, and we're still seeing on the real estate end of it tremendous short inventory, historically short now, even substantially shorter than last year at this time. And the last 2 years at this time have been historically short, topping each other. So that tells you with still strong buyer demand where we're at. It's now we're starting to get back into the multiple offer situation, and there's just nothing on the market for people to buy. And when you look at the data, the 250 to 500 range, 300 to 500 is where most of the sales and most of the listings are taking place. But that doesn't allow for a lot of options for people higher than that and people lower than that. And affordability is one of the big topics and concerns for the Wisconsin Realtor Association as far as priorities go. So that we can, continue getting people into home ownership. It's, it's going to be an interesting 2022. I do think there's going to be a lot more listings coming on in the next 60, 90 days, but it's kind of seasonally adjusted. We're starting off at a much lower base than we've ever been before. So we'll see where that takes us up to. Yeah. So this has been awesome. Yeah. Thank you for this. This is great. It really is, Sheri. I appreciate you coming on.
Thank you for the opportunity.
See, you're a star at this. You
not a star.
You were nervous, and you know what? You know your stuff, and it shows that you've been in the business a long time, and you can speak to it very fluently and understand it in a way that you can convey it to the consumer, which is, why you're successful, because you've got to be able to take complex information and products and concepts and be able to, talk to people about it so that they understand it. So.
Yeah, I mean, it's more than just getting a borrower pre-approved and having them find a house. As you know, the more educated the borrower is from day one, the smoother the transaction is going to be. So, I feel it's very critical for a lender to spend a significant amount of time with the borrower up front, especially if it's the first time, explaining to them the process, and this is what you can expect. And I tell my borrowers, let me worry about the loan. You worry about packing the boxes, because I'm not going to help you pack your boxes. But Yeah, and especially in these changing times, you know, I think we've got some pretty interesting times in front of us because, you know, really in a natural rate environment, rates probably should have been somewhere between a healthy economy.
Yeah.
Rates really should be somewhere between 6 to 8%.
Yeah, right.
But you say that to a consumer and they're going to fall out of their chair.
Yeah, no, you know, we've all experienced that, who've been in the business a long time, much higher than that even. And
Yeah, 12 and a half day one for me.
yeah,
12.5%.
that was like 11 and a half.
Yeah.
But there's generations out there now that haven't seen north of 5. So, you know,
yeah,
that portends interesting things for the future, right?
Sure does. Sure does.
Sheri, before we sign off, where can people find you? How can they get a hold of you?
So again, I work for Wintrust Mortgage in both Lake Geneva and in Burlington. And best way to get me is my mobile phone, or you can find me at sheriday.com through Wintrust.
You got your own website?
I actually have a website.
Nice, nice. That's great.
Yeah,
You're going to be a podcaster in no time.
Well, we'll see about that. Again, technology, not my best friend. So I have people like you and my assistant Sharon to help me out with that stuff.
All right. Yeah, that's great. It's great. It's fun to do, and it's important. This is an important message to get out, and I think it's very timely, especially this time of year, just in general, when people are diving into the market and they kind of need to know what's what, and you know what's the same that they can expect and what's changing that they were unaware of. So thank you for the great information. And
thank you for the opportunity. I really appreciate it.
Well, you're welcome. You're welcome. So we're going to sign off. I'm Chris Stevens-Senes, co-owner of Legendary Real Estate Services located in Lake Geneva. And you can go to our website, which is legendaryrealestateservices.com. There's a shot. And you can also reach out. My direct line, my cell phone is 262-745-2096. And to my 30-year friend, great interview. Thank you for the great information. I really appreciate it. And your bravery for coming on, huh? This was easy, right? It was easy and fun. Easy and fun.
I guess we have a different definition of easy, but you know, yeah, I enjoy talking about the mortgage industry, and you know, and I've been blessed to be in it for, again, 32 years, and we change with the times. You and I both, we roll with the changes in the times, and
yeah, you have to. Well, Sheri, thank you. It's been absolutely charming. I really appreciate the information. I know everybody's listening does too. And we're going to sign off, but thanks again. I hope to see you in person soon. Okay.
Sounds good. Take care, Chris.
All right. Yeah, you too. Take care, dear.
Okay. Bye-bye.
Bye-bye.